Hey, good morning, everybody, and welcome to this latest edition of Trading Places Live at earningsbeats.com. It is Tuesday, November 11th, 2025. I'm Tom Boley, Chief Market Strategist here at Earnings Beats. Certainly a pleasure to be with all of you again this week. Wow. I thought I was living in the South. Apparently, I'm not. It is freezing down here in South Carolina. Went out this morning and I think the wind chill was 19 degrees in November. I didn't sign up for this when I moved south, but I guess we'll get through it. Just a little shock to the system, that's all. But yeah, market has been kind of the opposite. It was cold for a little while, kind of picked back up again on Friday, and then we had a nice follow-through day yesterday. Back to the upside, which was nice to see. Futures kind of mixed this morning, though. Got a little bit of strength on the Dow, but mostly fractionally lower on the other major indices. I saw that the QQQs, which track the NASDAQ 100, down about 0.5%, a little bit less than that on the S&P 500. And I believe the small cap IWM futures were looking to be down about 0.2%. All of that with about 30 minutes left to go before the trading day starts. On the heels of what appears to be the end of a government shutdown. I think the House, I was looking at the latest news here, but the House is supposed to be voting on this package as soon as possible. I don't know exactly what that means. I don't know what the time is, but the Senate has passed the bill. We've got the House now waiting, and I think everybody is pretty much assuming that it is going to pass, which means that we'll finally get the government workers back to work. And hopefully start to get some economic reports back out again, because we haven't had those to work off of in quite a while. Market just seemed to be on cruise control for a bit without the reports, but then ran into a little bit of turbulence last week. We saw the market pull back. I think NASDAQ dropped about 3% or so. I mean, from my signals, again, doesn't matter whether there's a shutdown, not a shutdown, doesn't really matter what the news is. I follow the charts, and the charts are telling me that prices want to go higher. Yeah, we've got some issues out there. We were overbought. We've kind of worked that off a little bit. I wouldn't mind seeing a little bit lengthier period of consolidation, just because I think it would be healthy for the market, rather than just breaking out and moving back to all-time highs. I know that there are a lot of folks who, have got their money invested in the market, just want to keep seeing all-time highs day after day, but that does eventually come back to bite us. And especially the way the market's looking on the long-term chart. I mean, the S&P 500 has moved back up, and it is up against its channel highs, which if you can just kind of picture these two parallel lines going up, and when the market gets really, really bearish, really panicked, we go down and we test that bottom part of the channel, which doesn't happen very often in a secular bull market. It might happen twice, three times, maybe. But then the top side of that line is the upper end of what I believe is a reasonable channel and reasonable gains throughout a secular bull market. When you get outside that channel to the upside, to me, it just tells me maybe we're overstepping our bounds a little bit. And it was one reason why, one of the many reasons why I was not, I was very bearish, not bullish at all back at the beginning of 2022, because we were actually outside the channel to the upside heading into that year. So I thought that was just one more contributing factor back then that could have led us to some weakness, which eventually it did. So where are we now? Well, I look at a lot of, when I see the media, I don't listen to the CNBC. I really don't listen to news. I don't really get into all that. I'm probably the worst person in the world at current events because I simply just don't watch anything. So I've always got to hear things secondhand or hear it well after the fact. Most of the time, I can't tell what the difference is between news and hype anyway. So I just choose not to listen to it. But what I do listen to really closely are what's going on in the charts and the signals that the money is telling me. Where's the money rotating to? I think that's a much, much better signal than anything you're ever going to hear on CNBC. And so I look at that. I look for rotation. I look for the market to tell me a story that things are getting bad again. And I'm not really seeing that. In fact, I look at the numbers. You all know I do a ton of research. We do a lot of fundamental research at Earnings Beats. That's my background. If you don't know, I'm former practicing CPA for 20 years. So fundamentals are still near and dear to my heart as far as whether or not valuations are out of control or not, to the upside, or to the downside. But what really I like to follow is not just the fundamentals, but how the fundamentals and the technicals are aligning together. And part of that fundamental research that I do is I like to look at the earnings every quarter. I mean, I can't even tell you how many companies I look at between the strong earnings chart list that we do, going through all the earnings reports and then going through all the raised guidance. I probably look at 5,000, 7,000 charts over maybe a 3 or 4 week period. I don't know, a lot. And then we, any companies that report strong numbers where they beat top and bottom line and then meet certain other criteria, I put onto our strong earnings chart list and I annotate those charts, meaning that I'll draw on the charts where I think 1 or 2 levels of key support are, just that I see, very quickly, just visually looking at the charts. And then I do the exact same thing with the raised guidance. I go through all the companies that have raised guidance. I look at their charts and again, go through certain filters. And if they meet those filters, they go on our raised guidance chart list. And all I can tell you is that right now we have over 500 companies on both of these chart lists, which is as many as we've ever had. So for people out there saying that we're in a bubble, I would really encourage you to do some research, fundamental research, about how fast some of these companies are growing their earnings and the fact that they're beating expectations, because that is 1/2 of the 2 key barometers, as far as I'm concerned, in whether a market is overvalued or not. It's all about earnings and it's about interest rates. Interest rates are coming down and earnings are going up. Earnings are exceeding expectations. You can, beat your head into a wall all you want about how this market's overvalued and we're in a bubble. And I'll argue against it all day long based on just the current setup. Earnings are coming in better than forecast. I saw there was a article that I read about the S&P 500 companies and their earnings this quarter. And over 90% of S&P 500 companies have now reported for this latest quarter, and 82% of them beat on their bottom line. Now, a good quarter is normally 70 to 75% beat. When you get above 75%, you start getting up close to 80%. You've got a lot of companies that are beating. We're at 82% of S&P 500 companies are beating forecasts. So if you've got price earnings ratios and everything out there based on projections, you got to up those projections if these companies come in and beat earnings, because their future earnings. Again, I look at raised guidance. We've got a record number of companies on our raised guidance chart list right now. Companies are not only beating forecasts, but they're raising guidance. I'm sorry, but that in a rate environment, interest rate environment where rates are coming down, this is nirvana for valuations. So I don't know what to tell you except, from a just pure fundamental, what makes common sense to me, I think the market goes higher. And when I look at the numbers and I look at all the charts, I'm not seeing really any arguments. The charts, money is still rotating into offensive areas of the market. That's telling me Wall Street's not preparing for anything to the downside. If Wall Street doesn't move in and out for every little pullback in the market. So if you're looking at last week and saying, well, the market pulled back last week and you didn't see that coming, well, that's not really what I'm looking for. I'm looking for something that's going to have a little bit more depth to it, to the downside. Wall Street is not going to rotate in and out for every little pullback in the market. Wall Street takes a while to get out of trillions of dollars and move that money around and move into more defensive areas. Doesn't happen in a week. Doesn't happen in a couple days or overnight. It takes time. It takes several weeks usually for this type of rotation to take place. None of that is taking place on the charts as far as I'm concerned, based on my opinion and my interpretation. Anyway, now that we've gotten beyond all that and it's already 10 minutes into the show, let's talk about some charts. So let me go ahead and pull up what happened yesterday. Dow Jones Industrial Average. Let me see if I can make this a little bit bigger for you here so we can get a little better sense. Dow Jones Industrial Average gaining about 0.8% yesterday. S&P 500 up 1.5%. NASDAQ, there's your growth, up 2.25%, just absolutely blowing away the other indices. Small caps, mid caps, both up, although they did struggle a little bit later in the day, last 10 minutes especially. Saw a little bit of a pullback in small and mid cap stocks, a little bit more than in the other areas. But overall, still up. Volatility index down almost 8% yesterday, still in that 17 to 20 range. So still a little bit of a caution flag that's been kind of waving back and forth. I'll keep an eye on that. Market's still nervous, which means it's not going to handle bad news very well. And if we do happen to get back up through 20 and close above 20, that's when I start getting a little bit more nervous about the market, even if everything else looks great. I had a member write in not that long ago and ask me, because I look at certain things before many of these bigger pullbacks. And one thing is just obvious rotation away from growth and into value, away from aggressive sectors into defensive sectors. And one member wrote in and said, I look back at the bear market, cyclical bear market in the fourth quarter of 2018 and didn't really see any of the signs that you look for. What was that? What was out there that could have alerted us to the fact that 2018 was going to be, we were going to have a rough finish? And quite honestly, I didn't predict that going back into the fourth quarter. I didn't see a top there because my signals weren't showing it. But the one thing that did happen was the volatility index went up and shot up through 20. And if you avoid the market, or if you at least take some precautionary steps, maybe you buy covered calls against your positions, or maybe you just buy puts, S&P puts, which just acts as insurance against your portfolio. Anytime that the VIX goes over 20, I would be thinking about doing stuff like that. And if it turns out that it was just insurance that wasn't needed, oh well, you protected yourself. It made sense to protect yourself. It just didn't pan out. Now, I will say when the volatility index is higher, that insurance premium is going to be pretty high. It's going to be steep, because when the volatility is up, that's what that tells us, is that the pricing of options is extremely expensive. Market makers do that to protect themselves. They want, if you're, in a volatile environment, they want more money. They want more extra premium in order to sell you those options. And so you're going to have to pay more for insurance. But the flip side is, if you're doing covered calls against your positions, those options are more expensive. You're actually collecting more in premium by selling calls. Now, again, if you don't follow options, do some research. Don't just blindly try to trade options. Know what you're doing. You need to get educated in that area. But those are some things that you can be thinking about when the VIX goes above 20. Bad things happen. If you look at every bad period in the market, the worst of the bad period occurred with the volatility index over 20. So when the VIX goes over 20, just understand it's like, I always do weather or football analogies. A good weather analogy for me is like, I live in the South here. We have lots of thunderstorms come through. But if they say it's a 40% chance of a thunderstorm, okay, we might get some heavy winds. We might not, might be elsewhere, might not hit our area, blah, blah, blah. But sometimes they'll say there's a 30% chance within this range that there's going to be a tornado. You don't expect tornadoes with any old thunderstorm. Usually it's something that's different. There's different things that are present in the atmosphere and that leads to the possibility of a tornado. Same thing in the stock market. You have to have certain things present in order to have a bear market. A bear market just doesn't show up. A bear market is the result of a lot of other factors coming together first. And so that's why when people just, we're at a high, we're in a bubble, the market's going to drop 30%. Anybody who says that, I ignore them. They've never studied the market. They don't understand how it works. We don't just get to a top and just lose 30%. We get to a top, money rotates, Wall Street gets the heck out. They get out of Dodge. They don't tell us on CNBC, but if you follow the charts, they're getting out. They're moving into more defensive areas before we get those big hits. Now, in my opinion, when we don't see that kind of action, we don't see that kind of rotation, and the market gets hit, to me, there's a very good chance it's not going to last long. We're going to get that recovery back to the upside. And that's what happened in the fourth quarter of 2018. Long answer to a short question, but the signals aren't going to tell us every single time what's going to happen. Every bear market's not going to be called. I think the signals are awesome to follow. I think they give us some really good warning signs. They tell us when we need to be careful, when things are a little bit risky or way riskier than normal. And then you can decide, do I want to take on that additional risk and stay in the market? Or do I want to just move to the sidelines while it's that risky? Because even if it's risky, doesn't mean the market's going to go down. I've seen things look bad. I think it was back in September of 2000 after the pandemic. We had a big run, and I was nervous about the market, and I wrote about it at the beginning of September of 2020. There was an article. I'm sure you can go back into my Trading Places blog and read it. But we were seeing fear picking up while the market was going up, and the VIX was going up while the S&P was going up. And so at the beginning of September, I said, need to be careful because of this. And for the next 2 months, the market went sideways. It went down initially, but basically just went sideways. There was no bear market, but there were warning signs out there, and you have to decide, okay, do I want to pay attention to these warning signs? All I can tell you about the market right now is I'm not seeing a lot of those warning signs. Let's take a look at the sectors. So yesterday, when the market comes roaring back, one thing I like to look at when you're down, okay, the market, the aggressive groups almost always lead to the downside. That's normal because they lead to the upside. So that's where you're going to see your profit taking. So they go down when the market goes down. I don't worry about that. To me, what's important is when the market bounces back. If the market bounces back and we're still not seeing strength in aggressive areas, that starts to become a warning sign. Now, if it happens for a day or two, or maybe even a week or two, we can kind of get by and skirt by that. When it starts to happen for a month or two and the market keeps going up and it's being led by defensive areas, that to me is a much more significant warning sign. So after last week's weakness and the big reversal on Friday, I was expecting to go higher yesterday. I thought the market would rally. The question, if we did rally, was what led. And take a look at the leadership yesterday. Technology, consumer discretionary, communication services. Now, if I could draw up for you the three stocks or three sectors in order that I would like to see lead the market rally, this would be it. This is the poster child. Technology, consumer discretionary, communication services. Technology crushed back to the upside. Discretionary, communication services, the only other two groups that were up more than 1% yesterday. Look at what's down the bottom. Utilities, real estate, consumer staples, the three most defensive groups. If you're bullish and you get a rebound day, this is exactly what you want to see. So I don't know what's coming down the road. All I can tell you is that the market is not prepping for Wall Street. The big firms are not prepping for anything bad to happen here going forward. Let's take a look at the S&P 500. I'm going to show you the defensive groups down here on the bottom. So here's the S&P going up, been going up. And here's the defensive groups. You got healthcare, which actually has done okay here over the last 30, 45 days, but still on a relative basis, kind of hard to argue this is an uptrend. I mean, we were screaming to the downside for about 4 months, and now we're kind of going sideways, almost like a bear flag kind of a setup. Staples. Does it look like anybody is moving into staples on a relative basis? This is clearly the most defensive, one of the most defensive areas of the market, and very, very defensive relative to consumer discretionary. And look at staples just getting crushed, just set a new low. I mean, here's our bounce back. When the market weakens, that's when you're going to see defensive groups bounce. That's when you should, on a relative basis, see them bounce. But we get one good day and back down we go in the staples area. Then we got real estate setting new lows. The only area in defense that I think showing any strength at all was utilities. And it's really just kind of been, 3 weeks here or a couple weeks here. I mean, there was maybe a 3-week period, September to the middle part of October. Maybe the month of July was pretty good for utilities, but overall, again, we're still seeing relative weakness from where we were back in April. Now we're getting a little bit more strength here. And so I would want to see, obviously, all of these groups start to pick back up again in terms of relative strength. I'd like to see utilities go back to a relative high. I'd like to see real estate. Well, I don't want to see that because I don't want to see a bear market. But if you're bearish and you're looking for signals that would indicate something more definitive in terms of weakness down the road, something deeper, I think you would need to see the market move back up to new highs, and you would need to see more strength begin to emerge in some of these defensive areas. And I mean, just honestly, we're not seeing that. NASDAQ 100. Why is this thing? Don't know why this is. Try this again. There we go. Trying to get it all on one screen for you. All right, so here was the NASDAQ. Talked about the hammer that printed on Friday. Big gap up right back above the 20-day moving average, which is really important, not just because, short term, and we could meander back and forth. What this tells me, though, if we were starting a downtrend, I would expect the 20-day moving average to act as resistance. So we'd go up, we'd test it, we'd fail, and then we go to a new low. That's how normally a downtrend would start. A downtrend normally doesn't start by going below the 20 and then right back up above the 20. That to me starts to either means a bottom's in and we're trending higher again, or what it could be a sideways consolidation. And we won't know the difference until we see a breakout. If we see a breakout, then we'll know. But in the meantime, I think we marked an important low. On the NASDAQ 100, we tested that 50-day moving average. It's the second time, maybe third time if you want to count this time back in middle part of August. I don't think we quite got there, but we were close. But here we actually were beneath the 50-day moving average. We started a rally right back up to new highs. Here we come down, we go below that 50-day moving average. We rally back on Friday, print a reversing candlestick, a hammer, off of a downtrend that normally means higher prices, which we got yesterday. And by the way, these reversing candles don't mean, we're going to go higher for the next 6 months. This reversing candle to me means we're going higher the next day. So even if we were to lose 700 points on the NASDAQ today and go back down and close below the 50-day moving average, I would still say that reversing candle worked perfectly, because we got that reversal, came back up, closed on the high, and we went higher the next day. It's a short-term indicator. That's it. So anyway, right now, I think the NASDAQ looks good. I would want to now see that low hold on that candlestick. So to me, that becomes a pretty important level. I think we have a couple levels now to watch. If we're going to look at the NASDAQ here. Actually, let's annotate. So the low from Friday, I think, is now important. Also, the low from the Friday a few weeks ago. I really think that's a key area, a key zone for me on the NASDAQ now. And I don't know. I mean, if you really wanted to, you could draw this just a little lower, because we see this peak right here back in August before the pullback to the 50. You could say that prior resistance becomes support. And that actually held after we broke above. See how we pulled back here and we tested it and held. So maybe you give it a little bit more room. So let's just say somewhere in the 24,000 to 24,500 level, in my opinion, on this uptrend, I believe that's the major support. I think if we violate that at some point, we are either going to be in a downtrend or in more lengthy consolidation to the side. And in my opinion, the uptrend that we're in right now, that we've been enjoying for about 7 months, I think that it would probably be considered over until we get through a lengthier period of consolidation or correction or whatever. Now, again, what's the time frame of something if it does morph into a correction? Well, if we go back up here and we have a false breakout to the upside and we've got defensive stocks that are leading that charge, then I think we got potentially more problems to the downside. If it's aggressive stocks leading us up there, then I think we are probably in no more than sideways consolidation for a period of time before we break out. So it's all, not every up and down in the market is the same. You have to evaluate every one independently. But everything I can see right now points me to higher prices in the market. Not necessarily today or tomorrow, or, we're going to hit an all-time high next week. I'm not saying any of that. I'm just saying eventually I expect higher prices. I do not expect a deep sell-off based on what I'm seeing. And when I say deep, I don't expect a 10% correction. Forget about the bear market. That's 20%. I don't expect a 10%. And based on the way we bounced back yesterday, I'd be surprised at this point if we do take out that low from Friday. All right. Let's see here. Let's try this again. There we go. All right. So IWM bouncing. This was right about the 20-day moving average. We were above it. And then really right at the end of the day, we came back down, closed below the 20. So that would be the first step for small caps. We didn't do what we saw on the NASDAQ. We didn't get through and close above that 20-day moving average. So this one potentially is still in the possibility of a downtrend. And with futures down this morning, let's see where we are now. We got 4 minutes to go. I'll give you the IWM. We're at 0.3%. So we have gotten a little bit worse. We're looking to open at about 243.33. That's what we're showing in pre-market with 3.5 minutes to go. So yesterday's low was 242.25. I'd kind of keep an eye on that. I think in the short term, that's the support level on the IWM in the very short term, obviously. But further out, I don't think there's any doubt now for me on where the big support level is on the NASDAQ. I mean, we now have had multiple pullbacks to about 238, 237. So if we close below that level, I think things start to look worse for the IWM. Now, I could look at this and I can draw head and shoulder top. Up here, left shoulder, neckline, this double-headed top right here, back down to the neckline, back up into the right shoulder. So a breakdown here below 237 on a closing basis with increasing volume would not be good. So if you want bearish thoughts or bearish, something to think about from a bearish perspective, that would be it for me on the small caps. I'd be very careful on a breakdown. And I said last week to members coming down that from 241 down to 238, if you wanted to get into leveraged ETF, the TNA, that's the leveraged ETF, it tracks the IWM at 3 times the rate. So in other words, if the IWM goes up 1%, TNA goes up 3% in theory. But the best time to get into the leverage, in my opinion, is when you're testing major support. Because if you fail and you break below that 238, 237 level, you can get right back out of the TNA without a whole lot of damage. You don't lose at a 3-to-1 clip for very long. And that's the key to me, for me, with leveraged ETFs, is I do not want to be losing at a 3-to-1 clip for very long. So keep that in mind. But with the bounce on Friday, the gap up yesterday, we've now established quite a bit of room, got about 3% or so to get back down to that 237, 238 level from yesterday's close. Although, like I said, we are down a little bit here heading into the open. Transports, we've actually seen a lot of recent strength. We were down a little bit yesterday, even though the market was up. So that was maybe a little bit of a negative. But overall, we've been trending higher. I'm going to watch this rising 20-day moving average. When we did get moving back from April to July, you can see that rising 20-day held. And then once we broke below the 20-day, that's when we went into this sideways consolidation. So are we trending higher? History would support this because transports do love the month of November. So on any weakness in transports, watch that rising 20-day. But I do like the fact that transports have been showing some strength finally on a relative basis. The only question at this point is, does it continue to hold? All right. For those of you that are new to Earnings Beats, we have a free 30-day trial to our paid service. You do have to give a credit card, but we will remind you before the end of your 30 days. We're not going to charge you if you don't want to be a member of Earnings Beats, but you can check us out over a 30-day period by clicking on that link. You can go down to the bottom, follow us on our Earnings Beats Digest newsletter. Name, email address, that's all it takes. Tens of thousands of folks have joined us on the EB Digest. That's completely free, no credit card required. Charts come out 2 times a week. It's literally just 2 paragraphs in a chart normally. Sometimes great candidates, trading candidates. Sometimes, I might talk about sentiment, the overall market, what I'm seeing. Could be, I think beginning of this week, I looked at the software group because software at the end of last week was hitting a major support level. So if software bounces, that'd be a great opportunity to trade some of the stocks in that space. There's a lot of different things we talk about, but anyway, check that out. And I want to mention to everybody this Saturday, this is really cool. We got our fantasy stock draft. If you're an NFL fan, you get into fantasy football leagues and you like the stock market, well, we're marrying the two of them together. We're going to have a fantasy stock draft. So there are going to be certain requirements where we have to draft certain types of stocks. We can only draft so many. We got to fill out our portfolio. It's my 2 good friends from Stock Charts. Of course, I have a lot of good friends at Stock Charts, but 2 of my good friends at Stock Charts, Grayson, Roze, and Julius de Kempenaer, that are going to be joining me. This is going to be an interesting draft because I feel like I'm drafting against myself almost, in that all 3 of us really are heavily focused on relative strength. So there's going to be some strategy involved, for me at least, in trying to capture the stocks I want, because I know if there are really good stocks out there that I like that are performing well on a relative basis, they're also going to be high up on the list for Grayson and Julius. So I got to really think about the ones that I want to get at the very beginning and try to get those. And then maybe save some, maybe some of my, if I'm maybe reaching a little bit, I can probably save those for the latter rounds in the draft, thinking that maybe Julius and Grayson, maybe it'll fall beneath their radar. Anyhow, that'll be wild. And then we also have a 4th guest that's going to be drafting. And this is going to be a surprise for everybody. I don't think I let the cat out of the bag yet, but I'm not going to talk about it today. Come join us on Saturday morning. But I am not going to be a happy camper if I lose to this 4th special guest. I can promise you that. But anyway, we're going to have a great time. We always have fun, little smack talk going on, I'm sure. But they're excited about doing it. I'm excited about doing it. I think it'll be educational. We'll be using Stock Charts tools and so forth, talking about how we're picking our stocks and so forth. And then we're going to give you an opportunity to agree and disagree with us. So it'll be interactive. It'll be a lot of fun. But anyway, click on this. And when you do, all you got to do is sign up, name, email address. You can kind of scroll down, take a look at what we're going to be doing. But essentially, it is going to be a lot of fun. Maddie Slice, you're going to be hosting the draft. You've done a lot of these football drafts, so that's going to be exciting having you on there with us.
Oh, yeah, I'm excited to do it. Big fans of the Julius and Grayson, too, so excited to finally get on a call with them.
Yeah, I got to talk to you about giving me some special leeway here, though. I feel like I should have I should have a little inside advantage or something. I'm kidding, of course. I don't know if you have the slide. Do you have that slide that shows the QR code by chance?
I do. It's right there.
Oh, you got it up,
pull up on the screen.
Okay, so if you're on your mobile device, just go ahead and scan that QR code, and you can sign up that way. But we'd love to have you on Saturday. It's going to be a lot of fun. And even if you can't attend, sign up. You get the recording. Check it out at your leisure. You don't have to be there live, but it will be a lot of fun. And I really hope you can make it. We'll try to get done as soon as we can on Saturday. I know it's college football Saturday, so we're going to start at 10 a.m. Eastern. We should be done, I'm hoping, by 11, but that might be That might actually be too fast and not giving us enough time to have a little smack talk, but maybe 11:30, maybe an hour and a half. That's kind of what I'm thinking. Give you plenty of time to get out wherever you want to go by 12 to watch college football. Anyway, looking forward to that quite a bit. So it is now 9:35. Let's see what the market is doing. Probably down. That's what futures are saying. Yeah, we're down a little bit. Not really much of anything. Dow up slightly, like futures were pointing to, and a little bit of weakness on the S&P, a little bit more on the NASDAQ. But let's just see where we go from here. NVIDIA got earnings coming up now in November 19th, which is a week from, what's the day? The 11th, the 12th. So it's a week from tomorrow. NVIDIA reports next Wednesday. It's already had a pretty big run into earnings. It pulled back. Is it going to continue to push back to the upside as it heads toward its earnings? I don't know. It's going to be an interesting to watch stock to watch over the next week or so. But I do think NVIDIA is going to post some good numbers. Whether or not it's already built in, I guess we're going to find out. But I expect that we're going to see some good numbers there. Anyhow, that's all I got for today. Again, I'm not looking for anything bad. Some of you probably think I'm a perma bull. I'm really not. The market goes up more than it goes down, and my default is bullish. The market has to show me. I have to see on the charts that things are looking bearish, and I'm just not seeing that right now. So I'm sticking with the bull side. I think the market goes higher. Have a great day, everybody. I'll be back next Tuesday to do it again. And remember, sign up for Saturday's event. We're going to have a blast, so I hope you can make it. Have a great day, everybody. Happy trading.